How high will Fed rates have to go? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is George Goncalves, head of U.S. macro strategy at MUFG Securities. Hi, George. Great to see you again.
Great to be on, especially on Fed Day.
I know. And boy, it has been one heck of a sort of, drama driven last couple of hours of trade here. The Fed raised the benchmark Fed funds rate by 75 basis points as widely expected. But it was really the language around that decision. And I think not only in the statement, but the press conference, and I think some confusion, an initial read on it. And then listening to Jay Powell, the market coming back with a very different impression, which left us down sharply on the day. I should say, for anybody who's driving or listening to this, a really ugly finish for U.S. stocks. After an initial rally, we're down 3.3% on the NASDAQ, 2.9 on the Russell, 2.5 on S&P, 1.5 on the Dow. What did you make of the whole thing, George?
Look, for me, at the end of the day, this is really Powell pushing back. I mean, for many years, people would say Powell, it was pivot Powell, that eventually he would always pivot. There's that notorious, 2018 experience where the balance sheet was on cruise control, and then, that last hike for that cycle, and then a couple of weeks later, he kind of flipped the script. And I think that, obviously that's not what's guiding his decisions process here, but I do think that this is a much different Powell. This is a much different Fed altogether. It's a Fed that's realized that they were behind the curve, and they don't even know if all of their policies that they put in place are actually having an effect yet. So this is, still a hawkish Fed. They want to break this notion. The market's been trying for the last 3 attempts to say that they're going to pivot, and he pushed back on the pivot, reiterating the idea that just, if they slow down the pace of hikes, doesn't mean that they're actually done tightening, and that, it's more about the level of rates and how long they stay there. That's what matters. Not about the speed per se.
That's right. And that our question of the day came directly from Powell himself. And I thought he was really clear on that. It's how high they need to ultimately get that, not the pace, but how high they ultimately need to get that Fed funds rate, that benchmark that all the other banks use to set interest rates against, how high that has to go. And when we think about that, the terminal rate, by the way, you might hear people call it that's the big catchphrase we're hearing now. When we think about that, George, at what point do you think that they need to get to? The market seems to be kind of increasing where they think they're headed. What are you expecting?
Well, the market, from last I checked, is somewhere around 5% or higher. The last Fed dots, which they produced on a quarterly basis, which was updated in September, was around 4.625, call it. And what we heard from Powell too, which is kind of maybe either a Freudian slip or something happened in one of the questions where he mentioned that, the terminal rate is probably going to be higher. It's higher today in order to actually combat inflation versus what we expected in September. So the fact that he actually had that reference back to September, which they had their dots at 4.625, the market's at 5, that means it's higher than here. I think really no one knows, to be honest, myself included, that, what does it take for the level of rates to actually slow down, the aggregate demand enough, and they're using it through the blunt tools of largely financial conditions tightening, which is, really working its way through the stock market and the credit market. In other words, like stocks and credit have to go a lot lower, impact the wealth effect. All this operates with a huge lag, and you get a reference around, financial conditions in the past would react to monetary policy. Now it's almost the other way around, and then eventually impact the economy and then impact the labor market and inflation. It's just that, markets are reacting faster and wanted a quicker conclusion, mind you, but they're not getting it. And instead, we're going to have to wait to see how long this lag effect of financial conditions tightening will impact both the economy and the labor market, and it's not there yet. So is it 5? Is it 6? I mean, the traditional Taylor rule suggests that you need to get the level of Fed funds above the prevailing inflation rate, which, give it 6%. Do we really need to get the Fed funds to 6? Because if we do, it's not priced in anywhere.
Yeah, well, that's the question I was going to ask you is, so we saw that big reaction, and we know that everybody had been thinking that we were going to start to get maybe some indication that they were going to slow things down. Like everyone was really looking for that pivot language. So we may be setting ourselves up, said the bulls setting themselves up rather, for some disappointment. But when you say it's not priced in anywhere, I mean, as we were entering this end of the year, it felt like the markets were constructive. We know October was better. Everybody was maybe breathing a sigh of relief that some of those levels were tested. And even if we didn't rally again strongly, it didn't look like we were going to plumb new lows. Is this a whole new game now? I mean, are we looking at stocks that are going to go lower because the Fed wants them to go lower? And do they have to break those previous lows we saw?
I mean, our personal view, our house view is yes, I think so. I think that you need to see a proper, sustainable tightening of financial condition, not just a one-touch go on 3,500 on the S&P, for example. I mean, that was a move that happened during CPI day, and the market bounced back pretty aggressively. We had, again, a very powerful counter trend rally, primarily in October, off of what was a pretty big low in September. And that's fine. Like, markets are going to, not going to go down in a straight line, but this is a process. And if they truly are doing financial conditions tightening through these mediums, which is primarily the equity market and credit, it has to get tighter from here, which means lower in valuations. And I think that we haven't seen the lows yet. Ultimately, I think that is true for most asset classes. That's why I'm saying if it's 5%, that's definitely not priced in for equities, but it's kind of priced in for rates. If it's 6%, nobody has this priced right.
Which is a scary prospect. When we're looking at this inflation picture, the Fed has been pretty clear that inflation has been stubborn. That's why they're staying on this path. One of the things that we got today, earlier in the day, is the labor market, some labor market data. We have a jobs report on Friday, and the data coming out shows this labor market staying really strong. The private sector payrolls were higher than expected today. We'll see what happens on the government report. But how much of a problem is this for the Fed when they're trying to get that inflation contained?
I think it is their primary issue. Is they're nervous about the old wage price spiral that eventually, with the shortage of labor or just the tightness in the labor market, that people keep commanding a premium for wages, and then you have this kind of self-reinforcing mechanism around your inflation expectations. You're seeing the cost of goods going up, now you want higher wages, and if you can't break that cycle, then the Fed will then lose control of inflation expectations. The one thing that's good on their side is that the market believes them. Like, at least the tips market, even the consumer, the U.S. consumer is pretty sophisticated. People sometimes want to downplay the U.S. consumer. In the short run, we're nervous about inflation, we collectively as Americans. But in the long run, we're actually still thinking inflation will be contained because we think the Fed is credible. If they were to back down today, I think they would have lost some of that credibility. So I'm actually commending Powell for what he did, because I know this is a really hard decision on their part. But they are truly committed to getting price stability back into the U.S. economy at all costs, and that might mean at the expense of financial assets, but ultimately it'll provide a much more level playing field for the economy over the long haul. This is a classic boom bust cycle. I mean, you can argue that they were kind of complicit with this, given all the QE and all the sort of stimulus that happened before, but they've got the joke now, and they're going for it.
Yeah, I also think it's very easy, to Monday morning quarterback, and that we forget that sometimes that the whole quantitative easing process is a large experiment that we're still trying to exit in the first place. And then you have even though that's been going on for, you could argue, far too long, but still, I mean, there's not a playbook for it. And a global pandemic that shuts the world down, it completely no playbook for that. So, these are sort of uncharted territory, uncharted waters in some respect. By the way, if you have any questions, you know where to put them. You can drop them in the comment section, in the chat on YouTube, or you can put them on Twitter, and we'll get to them. It's interesting. I spoke with Jesse Felder recently, and he made the argument that, it's not a matter of when we think how inflation is going to come down. He thinks that there's some concern that we are in a different situation now completely, and that inflation is going to stay elevated no matter what the Fed does. Let's have a listen to a clip from that.
A lot of these things are pointing to structural forces for inflation. You have a change at the central bank in terms of policy. It's all pointing to a paradigm shift in the secular trend in inflation. We've had 40 years of declining inflation, and now we're probably in the early stages of a longer period of elevated inflation, which means everything that worked in the last 40 years for your portfolio is probably not going to work in the next 10, 20 years. You have to look at what are the things that work in an environment of higher inflation. And that's typically real assets. It's commodities, tips, precious metals, and certain types of real estate.
It was a fantastic conversation. That full interview is available on our website. George, are we in a structurally higher inflationary period now? Has there been a paradigm shift?
At a minimum, I think we need to respect that view. We have to respect the idea that it's now more likely than in any other period in our recent history that these forces that were described, that they might actually stick and stay around for much longer. It potentially could be a paradigm shift. And so I think that there is obviously there's two schools camps where either it is structural or we're going to go back to the way that things were before the pandemic. And maybe that's true, but you have to at least respect that idea that given commodities, given the deglobalization and all the kind of frictions that have been thrown into the system, that should increase the overall level of inflation going forward.
Yeah. And we saw today just the complications that continue around the supply chain. I mean, China, just a day after everybody thought there was maybe a different tone coming from policy leaders there, locking down the whole area right around Apple's largest iPhone assembly plant, heading into that critical holiday period. So supply chain issues seem like they're going to keep upward pressure on prices, but there's nothing the Fed can do about that. I mean, that seems outside their policy remit.
The thing is, though, and that's actually was a question that Chair Powell also fielded in some version of that. And at the end of the day, they have blunt tools and they need to impact aggregate demand in order to actually slow down the economy. And they also want to make sure that their hard, fought, credibility on inflation, especially now that they've regained a lot of it back, they're just not going to waver. They're going to stay the course until either something does really break in the economy or markets or both, and then they'll have a judgment call at that point. But so far, what has happened, other than we've kind of deflated financial assets over time, it hasn't been a epic kind of crash. Markets have been more two-way. So I think in their eyes, this is a healthy reset, and we're going to see what happens when they actually do pause. But even then, we don't know. So I feel like till whenever and argue that it doesn't work. It does work through the aggregate demand channel, and then that should at least level out supply down the road.
Yeah, I guess you could say there should be a better way that you don't have to break something and inflict that kind of damage in order to address it. That's probably that responsibility probably falls elsewhere, not in the Federal Reserve's lap. But that's the worry. Do you think when they talk about being data dependent, that concerns about financial stability are part of that? Because that's the balance, isn't it now? We got to use this blunt tool. We know it's not perfect. We know we're going to inflict a lot of damage that we otherwise, wouldn't want to, because that's the only way we can get inflation down. But how far it's that, can they do both? And everybody says no, they can't. They can't maintain financial stability and completely kill inflation. So how do you think they're looking at that delicate balance?
And look, and again, I'll go back to one of the questions he had too, which is, can you soft land or can you narrowly kind of work through this very delicate process, both financial conditions and the economy? Look, I think they've made their choice. Their choice is price stability at all costs, and they're gonna go there until there's either some pushback that's clearly evident. We haven't seen it yet, though. And so the other thing, which you have to think about, especially for economists, if you're reiterating your model and you're going through and you're not seeing an actual impact from your actions, you're just going to do more until you actually get some sort of pushback or feedback. And we haven't seen enough feedback. Yes, again, we could say stocks are down, but it's been a repricing of valuations. It has been relatively orderly. Same thing with credit. Credit markets are still opening and functioning. Treasury market has had some issues with liquidity, but it's still functioning. If any of those sort of variables were to change, and in a very material way, then yes, the Fed has tools around that. But I think even then, I think we'd be remiss to believe that they're going to somehow come back with a massive QE program or slash rates back down to zero. They're not going to do that. They're going to have much more tactical approaches going forward when it comes to financial conditions, in my opinion. I just don't think they're not going to blanket the economy and markets with trillions of dollars like they once did.
Yeah, they're going to be a little bit more surgical about it. I think that's a very, very important point, George. Manis from the RV site asking, how low is the expectation for the S&P 500? Is 2,800 a possibility?
So I'm not the equity analyst. Obviously, I'm a macro strategist, and I primarily focus on U.S. fixed income. But of course, we all look at every single asset class to kind of inform our view. I mean, look, it's a function of both where we think earnings are going to go, as well as where there's their value in the system. I mean, 3,200 was the prior high prior to COVID. 2,800 is 14 times $200 earnings, right? I mean, you can easily make the case for it's somewhere in between 3,200 and 2,800 is some sort of place where maybe there is some value or value starts to form. But between now and anywhere between 3,200 and where we are now, I still think that the market is not, really taking into account how aggressive the Fed's going to be at really crowding out capital. Think about it. You're going to get paid at some point, potentially 5+% on plain vanilla treasuries, high quality corporates in the 7-8 handle. You're better off buying fixed income than buying equity, considering what the Fed is basically doing is forcing capital back into fixed income.
Yeah, which is really interesting. So I have some questions about that, but I want to ask Timothy's from the RV site, which is in your wheelhouse. Thoughts on high yield junk? Now that's not what you were just talking about, but his concern is that the place where we haven't seen the lows yet, the thing that breaks. Been a lot of concern about that. People expressing a lot of surprise that we haven't seen more action, more spreads widening out in that area.
So the one, there's been a few kind of supporting features this past year, which really come that are linked back to the pandemic as well, where many companies took advantage of the low rates, tight spreads to issue debt. So many companies can still weather this storm, and it really comes down to now the point about the Fed saying how high and how long they can stay at upper levels of rates. Then it becomes more of a waiting game. Like, how long can you afford this kind of debt servicing cost? And really trying to figure out the companies that really can't afford this, debt servicing is really what's going to come down to. I mean, there's pockets within all the different parts of credit that are going to be exposed to that issue. I still have been very clear on it's the floating rate, issuers that have a lot of floating rate debt that are now exposed to this higher rate environment. And yes, high yield or the more junkier part of the credit system has kind of avoided a lot of this so far, and it's been a function of less supply because they've been pre-funded before during the COVID time period, so they have a lot of just capital that they've raised beforehand, so they're trying to weather things out. And we haven't had the proper recession yet. So we haven't had the true decline to free cash flows or impact on delinquencies and defaults have not picked up enough yet to really make high yield or credit investors nervous and not just buy the dip, which they're also kind of guilty of doing similar things there. So less supply that's been issued throughout the year, both for investment grade as well as high yield, and a kind of a tribal kind of effect that many of these managers, they only live in their own little world around high yield. When they have extra cash, they put it back to work into high yield, and that less supply kind of has been keeping spreads narrow. I think that's going to be unsustainable going into 2023.
Yeah, great point. And you were just talking about cash flow, and we have seen the earnings come in, and while we're hearing about cautionary forward guidance, the earnings have all in all seem like they've been better than expected. You haven't seen that cratering in most areas that people expected.
Yeah, no, that's the thing. Financial conditions work like a slow moving train wreck, and it takes so long to go through. By the time you see it, you're off the rails. And so I think that's early 2023, and that's what the Fed pushing rates as close as they can, maybe even above 5%. And I think that's when we'll start to really feel that pinch from this overall tightening of both the interest cost on companies, the quantitative tightening that the Fed's doing with their balance sheet, taking liquidity out of the banking system. I mean, all of these things, the dollar strength, there's so much tightening happening right now. If the U.S. doesn't fall into a recession, I'd be amazed.
Yeah, that's such a great point, George. You know who sees that train wreck coming? Evidently is the bond market, because this is why we've been seeing this inverted yield curve. And some folks pointing out, wow, the Fed is tightening into an inverted yield curve. That's not something you see very often. Does that mean that if you are looking at treasuries that you need to stick to the shorter end, to shorter duration, or would you be looking at that longer end as an opportunity?
I mean, I think look, it depends. Everyone has different
Right. Everyone's risk
investment
profile. With that as a
risk
caveat,
profiles.
yes.
Yeah, and look, I think I've been relative defensive and suggesting defensive plays around hiding in the 1 to 3 year part of the curve and just keep reinvesting as bonds mature, or if you are in an actual ETF or something like that, just stay very short until we actually have a better handle that the Fed has done. It's clearly they're not done from what we heard today, and so you have an opportunity to keep reinvesting at higher rates. I think that's the way you play your fixed income portfolio. You don't extend duration yet. Having said that, I mean, having some barbell is not a bad idea. The closer we get towards seeing these growth signs, we're already weakening. So we're already seeing housing, really suffering here. Other sectors in the economy are going to continue to suffer. The consumer side, I mean, cyclical, all this stuff is going to start showing up towards the holidays in the early part of Q1. So that maybe by then it's too late. So here's the thing. So the Fed is still raising rates, so the bond market still respects the Fed. So even though there's an inverted curve, every time the Fed raises rates, even long-term rates go up too. So as long as the Fed is raising rates, we just don't know if the 10-year is going to stop at 450 or 475. It will stay inverted. You might be able to average in at a better level down the road, is my point for the 10-year. Whereas holding some cash on the front end and waiting for the opportunity is probably the better bet in the next couple of months.
Yeah, that makes sense, right? Because even if it's inverted, doesn't mean it's all not drifting up as we sort of try to figure out where this Fed level is. Great question. Great question. Not easy for me to say. Great question from Robert. What asset class do you believe is the current best case safe haven? Sounds like maybe you're saying short-term bonds, but is there something else that you're looking at as well?
I mean, I think some of the points that Jesse mentioned, I think are spot on. I mean, it's still an inflationary environment until proven otherwise. So any sort of inflation protected investment strategy, be it tips, um, you know, I'm sure you've read all the stories about I bonds and the manic obsession about everyone going after I bonds. But I think any sort of inflation, all joking aside, all sort of inflation protected type securities still makes sense, because even let's say the Fed does get their arms around inflation, over a 3 or 4 or 5 year window, if the Jesse view is right, you have the risk of the echo, like the second wave of inflation coming back, where you think you've won the battle, but it's just the war, but you actually won a battle in inflation. Then you have a second wave of inflation in 24, 25, 26. So having some shorter dated tips that will allow you to participate in a second wave of inflation makes sense. So just having short-term T-bills, which allow you to roll into higher yields, and then maybe you take some of that money and move towards inflation-protected securities over the course of the next 6 months.
Well, what is your take on the craziness going on with I bonds? Somebody just asked me about that the other day too. What is your sense of what's happening there?
I mean, look, it's a vehicle. The thing is, there's only a limited amount that investors could actually participate in, and so it's not really meant to be a trading vehicle. It's more like a savings vehicle, more than it's like a savings bond. It's a savings bond, but I think it's just it's reflective of this concern about the need for real assets and where to actually there's only a limited amount of real assets. Real estate probably won't do well initially because we're probably heading into a recession. That's our base case, but at some point real estate will still be a good store of value. Anything that generates good positive cash flows and that has indexation to inflation is what you want to be in over the coming years.
What is your take on the dollar, George? We know that dollar strength has been a concern for so many. We don't have it up, but I just noticed right before we went on, Michael Cow at Urban Cowboy saying his take on the meeting. Powell, the strong U.S. dollar is a problem for some countries, but we have a strong economy over here. It's every man for himself dynamic amongst the world's central bankers. They certainly seem to be tolerating a stronger dollar. Does it continue to go higher from here? Or, again, is this the risk where we see things, this is where we see something break that's going to concern everyone?
So historically, if you go back and look at the annual return of the dollar, whenever there's a 1 year rolling return of over 15% or 20%, somewhere in that range, something breaks. It's broken going back to the 1980s. I'd be impressed that it doesn't happen again this time. And there's that dynamic, but you also have to think about it from a U.S. policymaker. Although the Fed always, I feel, feels conflicted in many ways. They know the dollar is the reserve currency, and they also know it's the main medium of exchange, and so that's an important thing, from a strategic advantage for the U.S. But at the same time, a strong dollar, especially in an inflationary environment that we are now, is actually a good thing for the U.S. We're an importing nation. Just imagine if we had a weak dollar, and then we would really be reliving the 1970s, like Carter time period. If you had a weak dollar with all the inflation that we have now, the inflation would probably be like 11 or 12% if the dollar was not as strong. So the fact that the Fed is like kind of looking the other way on the dollar, I think it serves our best interest that we have a strong dollar, especially in an inflationary environment. At some point, when they get their arms around inflation, they're going to want the dollar to kind of weaken a little bit. Otherwise, the U.S. won't grow down the road.
Yeah, but and of course, meantime, there's an enormous amount of strain that's putting on just about anywhere else. By the way, on the site, there's a great master class, an inside look at the Federal Reserve, what constitutes money, and how do central banks control it. Really, really great look from Joseph Wang, who is a former Fed person, and our own Mike Coolbot, really going through all of that. So if you're interested, go check that out, because I think it's really informative of how this all works. And to George's point about this really delicate balance the Fed is dealing with when we look at the U.S. dollar. George, so it's so interesting. This is, I think, a really sort of critical time, because once again, we were talking just before we came on air, and it's like everyone gets to this point where we think the pain's over and this is it, and the Fed's done the hard work and they're going to pivot, and everyone gets excited for it, and then the market just gets slapped back down again. What are you most concerned about as we head through the end of the year?
Well, again, I commend Chair Powell for doing this, because we want markets to get to a point when there is a bottom. Who knows where the bottom really is? I don't know either. But people usually, when they kind of give up on this idea of pivoting or easy money, and everyone just kind of throws in the towel, then you're closer to a bottom. Everyone expecting the Fed to bail them out has to like re-engineer their thinking. Like the Fed is no longer your friend and on your side and providing liquidity. They're in fact taking it away, and they're making the cost of funding much more expensive. So now it's all about fundamentals and where we think the economy is heading. You have that to think about from the medium term. So we have to really retool and rethink the way that we've operated for the last 15, 20 years, where the Fed's always had our back in many ways. This is a completely different environment, at least in the short run for now. So we have to, like, if I can start seeing investors no longer try to call the pivot, then I'll feel we're closer to the bottom. And so far, people still want to buy the dip. They still think that there's value out there. And so we have to get that out of the system, just purge it a little bit. In the short run, I am nervous about into year end, because now the Fed has clearly said that that they're not done yet, and that their terminal is probably higher. We have the Fed meeting in December. We have the midterms next week, and we have a lot of other things which I think have been sometimes overlooked, but actually even more important. It's what the other central banks around the world do, not just the Fed, because everyone's trying to play catch up with the Fed, and like the Fed's kind of on an afterburner, taking off and like really leaving all the other central banks behind. They're not going to be able to keep up pace with the Fed. No, there's no way. I mean, I think like the others, like the ECB, we were already seeing the Bank of Canada, start to come under pressure because of their housing market. Like the Fed is going to go for it, where these other central banks probably don't have the flexibility to do so. So watching how the other central banks react might create like these like overnight volatility in markets, and also the dollar can stay bid or even get even stronger, and that could create a perfect storm into the end of the year where liquidity becomes even more precious and the availability of balance sheets get taken down. This has been a rough year for the markets, even rougher because a traditional 60-40 portfolio hasn't worked in your favor. But think about the bond holdings and the bond investors that are on the other side of that. They just don't have the animal spirits or the willingness to actually take down the market if they need to. So if balance sheets were to get constricted into year end and the market's trading down, it could be very gappy, and liquidity could be a big problem.
Yeah. And my takeaway, the translation of that for everyone, is that that's a lot of pain. That's a lot of pain and a lot of liquidation. People sell everything in that situation, or anything they need to, in order to, to deal with that lack of liquidity and counterparty risk. And George, if I'm looking at what we're talking about, the Fed not done, take them seriously at their word. They care about credibility. They're willing to break some stuff in order to get it done, as they've been telling us. But it is true, there is no pivot, and there's a risk that the ultimate rate at where they stop is a lot higher than the market's pricing in. Certainly higher than stocks are pricing in, but possibly higher than bonds are pricing in too, which, added with your liquidity concerns, is something that we all need to be very concerned about. And if you're looking for a place to hide, short-term treasuries are probably the best bet, but it's going to be some rocky times ahead.
Absolutely.
All right. Well, George, it's always fantastic to catch up with you. One of these days, we're going to end on a really positive note, but not on a Fed day, not when you come visit on a Fed day right now, if Jay Powell's got his way, right?
We got to see inflation head down, not just a few more meetings or a couple more months. We've seen inflation really come down. The Fed stop being hawkish, and then maybe next summer we'll be a little bit more dovish and happier.
That's right. And maybe the silver lining is that Powell himself said they don't really understand inflation. So hopefully we'll see a quicker turn than anybody expects, and we'll be having a different conversation. Maybe that's something we can hang on to. George, always great to catch up with you. Thank you so much. And thanks to all of you. Great questions. Thank you for your time. We'll be back here same time tomorrow. In the meantime, take care and good luck out there.